Almost everyone has heard of the VIX, the stock market's fear gauge. Almost nobody watches its older, quieter cousin, the one that measures fear in the bond market. And yet in some of the biggest market accidents of the last 2 decades, that bond gauge moved first, days before stocks noticed anything was wrong. It is called the MOVE Index, and it is arguably the single most underrated early warning light on the whole dashboard. This is the story of what it measures and why the rates market is so often the first place trouble shows up. Here is why it matters. The bond market sits upstream of almost everything else. Government bond yields are the price of money, the discount rate under every stock, every mortgage, every loan. So when uncertainty about interest rates spikes, it does not stay in bonds. It flows downstream into credit spreads, into the value of collateral, into how much leverage the system can carry. That is why the MOVE often leads the VIX. The rates market is where uncertainty about the central bank gets priced first, and the central bank's reaction function is the biggest question hanging over every other asset. So, what is the MOVE? It is an estimate of how much investors expect Treasury yields to swing, built from the prices of options on interest rates. Think of it as the bond market's implied volatility. There is a rough map for reading it. Below about 80, the bond market is calm. Between 80 and 120 is moderate, a mixed environment. Above 120 signals stress. For context, in October 2025, the MOVE sat around 69, unusually calm. That calm is exactly when this gauge is most worth watching, because calm is where complacency builds. Now the mechanism, and it is a chain reaction. When rate volatility jumps, the value of the safest collateral in the system, treasuries, becomes uncertain. Lenders respond by demanding bigger haircuts, meaning you can borrow less against the same bonds. Leveraged players then have to sell to raise cash, and because everyone holds the same treasuries, they sell into each other. That selling pushes yields around even more, which raises rate volatility further, which tightens collateral again. It is a feedback loop, centered on the plumbing of the financial system. The MOVE is the thermometer for that loop, and when it climbs fast, it is telling you the plumbing itself is under stress. History shows what those spikes look like. In March 2023, when Silicon Valley Bank failed, the MOVE rocketed from around 130 to roughly 200 within 48 hours, while the VIX took days to catch up. Its all-time high was about 264, set on October 10, 2008, at the height of the financial crisis. At the other extreme, it touched a record low near 37 in September 2020, when central banks had flooded the system. Each time the gauge screamed, the trouble was already in the pipes. Each time it whispered near record lows, the market was at its most comfortable. And comfort is where fragility hides. So add one number to your dashboard. Not because it predicts the next crisis, it does not. It is a lens, not a signal. But the MOVE tells you which kind of environment you are standing in, one where the rates market is calm and shocks get absorbed, or one where it is straining and shocks get amplified. When the loudest gauge in the room, the VIX, is quiet, it is worth checking whether its quieter cousin agrees. The forward question is the one worth sitting with. What happens the next time this gauge is near record lows, and the market has forgotten it exists?